We got Paul on the line. So, Derek, what do you want to ask him?
So for the current market and how volatile things are right now, how do you manage the risk in the multifamily investments that you guys are working on or have?
Yeah, the way we manage risk is extreme due diligence. We do as much due diligence on the operator as we can. Then secondly, the due diligence on the deal. And then third, changing our place in the capital stack by going down to pref equity.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital Group. Really excited for today's show. We've got two amazing guests on the line with us. We've got the very distinguished Paul Moore, and we have the also very distinguished Derek Buescher. And guys, welcome to the show today.
Thank you.
Great to be here. Thanks, an honor.
Awesome. Well, appreciate you guys. And as is tradition, Paul, you're going to be in the hot seat first. So welcome, and do us a favor. Tell us a little bit about yourself, and understand you might have a little joke to tell us too.
Oh, well, yeah, I'll start with a joke. So, actually this happened last night. Sure. Yeah. I met a woman outside the mall who was crying. She had just lost $200. So I gave her $40 out of the 200 I just found.
Nice.
Okay.
Yeah.
Anyway, enough comedy jokes, but seriously, I'm Paul Moore, and I made a lot of mistakes over the years. The first big mistake was an engineering degree, but I fixed that by getting an MBA after that. And I worked at Ford Motor Company for 5 years, and then I launched out as an entrepreneur. Never looked back 30 years ago. I've been investing in real estate for about 23, 24 years now. Started out in single family, did flips, converted over to commercial level around 2011. And I tried to be a multifamily syndicator, and I wrote a book on multifamily, humbly titled The Perfect Investment. And then broadened out into other asset classes as well. So we have several funds at my company, which is called Wellings Capital.
Nice. Now, going back, you said, one of the mistakes was the engineering degree. Why do you call that a mistake right now? Just curious.
Yeah, I didn't know what I wanted to do. I was a kid, and someone literally at a pool told me, he's like, hey, geology's cool. You can check out rocks and climb mountains. I'm like, okay, that's what I want to do. Yeah. And then someone else told me, well, yeah, but you can make more money if you get a petroleum engineering degree with a few more classes. So I said, okay, that's what I'll do. And petroleum engineering, like when I went in 1982, there were 7 graduates that year, 4 years ahead of me, and they had 7 job offers each. And when I got out 4 years later, of course, there were like 89 graduates, and we had 7 job offers total. Yeah. So I kind of lost my heart to be just a petroleum engineer, which it's a great field, but I wanted to broaden myself and get an MBA at that point, and I'm glad I did.
Interesting. Yeah. I'll be honest, I got 2 degrees in math myself, and I remember my uncle telling me when I was young, and I know where I was. I remember where I was when he told me this, and I remember which house it was, and I can say it was before I turned 9. Because we moved out of that house, when I was, 9 years old. But he told me that people who are really good at math make a lot of money, right? And I think he said that because we had just taken standardized tests, and I scored extremely well in math. And I remember thinking math equals money. And, 10, 12 years later, when I started college, I majored in math. But I don't know if I'd call it a mistake, but if I were to go back and relive my life, I wouldn't have majored in math. I'll tell you that.
Yeah. So. Seriously, guys, isn't it amazing the impact an adult's comment can have on the entire course of someone's life, to adults and kids? It's amazing.
And it was an adult that I respected too.
Yeah.
It was actually my dad's uncle, and it was my
Yeah.
dad's go-to every time he had problems. And so my dad spoke very highly of him. And so when he gave me 10 seconds of his time and said, people who are good at math make really good money, he probably does never remember saying that, but I did. Yeah. Good point. Good point.
Yeah. It's amazing. I mean, my life's been steered so many times. I've never shared this on a podcast, but I was driving. I remember where I was, in fact, and it was, I'd already been in commercial real estate about 3 years. But someone made a comment offhanded on a phone call, don't become a multifamily or an apartment owner. And I said, why? He said, they're so hot. They're in such high demand right now. And it just got my curiosity up. And I thought, well, maybe I should consider that. And then like literally within a day, I was on the phone with my future mentor in multifamily syndications, and my whole life changed.
Yeah. Yeah, it is interesting. I think, lesson learned from that, surround yourself with the right people and make sure you have the right people feeding you stuff like that. But
true.
What's also interesting is, our society is asking 18 and 19-year-olds to decide, the ones who go to college, what to major in and what they're going to spend their rest of their life doing, which I wasn't ready to do at that age. But
no.
So, well, cool. So let's talk about like your entrepreneurship journey. I mean, you said you had a job at, I think you said Ford. Let's talk a little bit about launching into entrepreneurship. What took you away from the corporate world and into what I like to call the fly by your seat of your pants world of being an entrepreneur?
Yeah, so I really liked Ford right off the bat. My really close friend from my grad school went to Ford also, and he didn't like it. And he was an entrepreneur guy from day one. So he started looking to start something on the side in the evenings within literally a month or two after we both went to Ford. So I just thought I'd join him.
Yeah.
And we piddled around with a bunch of stuff over 4 or 5 years, well, actually 4 years. And then he got something that really made sense and worked. And so I joined him in my evenings and weekends back before the internet, in 92, just by doing a ton of, library research and all that. And I made a goal, and this is a weird memory. I remember I had this day of solitude and silence and journaling, and I wrote out all these ideas, and I made a goal that 13 months by a certain date, I would have replaced my income at Ford and quit Ford. And it was May 30th, 1993, that I wanted to quit Ford. And in April of 93, which was a year into this promise, I'd only reached 3% of my goal. Okay. So it wasn't looking too good for May.
Yeah.
But then I landed a huge contract, and I quit almost exactly on the day I had written down 13 months before.
Wow.
It's really powerful.
It is. I made a similar goal. I wanted to walk away from, my military career, and I was comfortable. I think that was the worst part about it, is I was comfortable, doing what I was doing. But my date was October 31st, 2021. And I made that goal with about 2.5 years. And my goal was to replace my income in that time frame. If you look at how much I made from real estate in 2021, it was within $5,000 of what I made from my active duty income.
Wow.
And it was like, you hit your goal. I hit my goal on the nose. You hit your goal on the nose.
Yeah.
I mean, I look back at that, and I hate to say it, but what comes through my mind is, man, I wish I would have made higher goals. I wish I would have reached a little bit higher.
It's so true. And we could probably spend the next hour talking about this, but your comment earlier was powerful. And that was, you make sure you surround yourself with the right people, because even the right people's random comments, like the math or the geology, they could actually change the course of our lives. And so, and I think that's what you do so well on this podcast, because you are putting people in touch with other people. And that's wonderful.
You just remind me of another right person comment that changed my life. And this was about a year ago at a conference. I was with somebody who's far more successful than probably the three of us combined, if you look at his balance sheet. and I was telling him what I wanted to do. And I had just left a partnership, and I mentioned I'm just trying to find the right partner to go forward. And he made a comment that was very directed, and after listening to my story, knowing a little bit where I was from, he just says, yeah, you don't want a partner. You want to hire somebody. All right. And that got my mind spinning. It was like, I had never thought of it like that before. And, a year later, I've hired now 4 people, and yeah, I'm more excited for the future than I think I ever was. But
that's great.
Surround yourself with good people. So
yeah.
Well, Paul, we're going to shift gears a tiny bit, and I want to talk a little bit about motivational stuff. So I like to call it your big burning why. So what motivates you? What is your why?
Well, I don't know if you guys have seen the Sound of Freedom movie. I'm actually taking a quick note here. Sorry to be rude, but
no worries.
On the random people, that is really just a golden thought I want to think about more. Thank you.
Yeah,
the Sound of Freedom. But if you took up through 2022 at least, or 21 at least, if you took the record profits, not the average, the record profits of Apple, General Motors, Nike, and Starbucks, added those record profits together, doubled that number, that's the approximate profit of human trafficking every year. And it's horrifying. And, but when I hear that, I don't know what to do. Do I join a commando raid? Do I try to go down the bush country and try to rescue some? That's not going to happen. Do I send money to somebody that I don't really know what they're going to do with the money? And so anyway, our company, Wellings Capital, we're basically a due diligence company. We do due diligence as well on nonprofits. And we've got 1 or 2 we really like. And so my burning why is, first of all, and I'm stepping back from what I was about to say, first of all, to give our investors a fabulous experience and protect their principal, hopefully give them cash flow and appreciation. And that really is our number 1 why. But the other why that goes along with this is obviously raising awareness and money and trying to rescue people out of human trafficking and to put the bad guys behind bars.
Yeah. So just curious, there's one that is kind of prevalent in my community. What are the ones you like that you have vetted?
Thank you for asking. We really like Exodus Cry, who did an amazing movie about a decade ago exposing this, and the movie's called Nefarious. Now there's a brand new movie called Nefarious as well, and I've heard nothing but great things about it. But Nefarious from 2012, and then the organization we're actually raising money for mainly is AIM. That's AIM, and their website is aimfree.org, AIMFREE.org. And our goal is to, we've raised almost 400,000, but I have to verify that because we raised 250,000 in one day. So that was from some wonderful people at Collective Genius. I don't know if you know those guys, but it's a great group. But at any rate, we would like to raise 200,000 more in November. If anybody wants to be part of the match, let me know. Of course, you can give directly to them as well.
All right. Well, we'll put information for that in the show notes. And if you don't have to go now, but after the podcast is over, if you want to send information for how to join you with that, first of all, I'll send $1,000 your way. That's easy to do. It's a cause that I really like.
Thank you.
It is a cause that I really, really like. So yeah, I'll do that.
Right. So, wow, thank you. Yeah, so what we're doing, I don't want to spend a lot of time on the show on this, but we're trying to get a big match so that on the Giving Tuesday after Thanksgiving, we get a lot of people that come in, and then we have a dollar for dollar match. But thank you, Brian. The match, just so you know, the match will just be like, you just say, hey, I'll put up 1,000 if you raise 1,000. So you're in for 1,000. You're good.
I'm in for 1,000. Cool. Awesome.
Right, thanks.
So there we go. Well, let's see. Question I always ask, and we'll go back to the real estate topic, is give us an idea of one of the projects you've worked on. And I know you've done a lot of different commercial real estate. So, pick whichever one you want and give us an idea of, how things have gone.
Okay. Can I tell you about a new one we just invested in yesterday?
Absolutely.
All right. So this is in the Houston area. It's a pair of about 10 or 15-year-old multifamily assets. The acquisition price was $80 million. and we were an investor in that. Now, believe it or not, the total equity was 26 million. Believe it or not, according to the lender's appraisal, the value of the property went up by 33 million the day we closed.
Really?
Yeah. And so we love investing in these tax abatement deals because, as you know, Houston, or I should say, Texas property taxes are really, really high. And so, since the value of a commercial asset is the net operating income divided by the cap rate, well, when the NOI goes way up, as it did here, it significantly drives up the value as well. And so the 26 million in equity, at least on paper, went up from 26 up to, I believe that's 59 plus million.
Jeez.
So what I like best about that is it creates a really nice high margin of safety, or as we would say, a debt service coverage ratio that's really in the safer zone in case anything goes wrong. This is a 10-year interest only loan locked in at a 5.5% interest rate, I believe. Of course, there's no guarantee this will go well at all. But I have to say that
good buffer.
Clients. But it's this group's got over 80 deals they've done this way, and all but one of the 89 deals or whatever has gone really, has been positive outcome for investors.
Wow. So 5.5% interest only. Was that a new loan, or is that?
Yeah, they bought it down.
Okay. Bought it down. Okay, good.
Yeah.
Okay. All right. I was going to say, I haven't seen anything, brand new starting with a 5 in quite a while. So,
right.
But buying down interest rates, that works. Well, cool. It sounds like a great deal. And I mean, anytime, that appraisal comes in a lot higher than what you're expecting is a lot of fun. It's a good day.
Yeah. And just to be clear, they did a tax abatement. So for 99 years, there'll be no property taxes on that property, which it is transferable to the next owner as well.
Wow. Yeah. And that's huge because, I mean, when you look at Texas real estate, the two biggest wild cards in the last couple of years have been taxes and insurance. It's, you never know what the tax is going to be from year to year. And sometimes that hike can be huge. So if you can eliminate one of that's a very volatile number. If you can eliminate that volatility, man, over a long time, wow, it sounds awesome, actually. So, and I assume that the tax abatement is what led to that $33 million increase in valuation too, right?
100%.
Yeah. Okay. Yeah. Wow. Good deal. Yeah. Interesting. Well, last question, and then we're gonna bring Derek on. What's next for you?
We're doing more preferred equity than we ever imagined. And for time's sake, I won't get into a lot of it, but it's similar to mezzanine debt. It sits in the middle of the capital stack. It doesn't have a lien on it like debt does, but it has much, hopefully, projected, at least, I have to say for my compliance folks, projected higher returns and projected better safety.
Yeah. And I mean, preferred equity, I think a lot of people right now are looking for preferred equity providers as well. If you're looking at it from a common equity tranche or from sitting in just a regular investor, it does put them at a little bit more risk, but the extra leverage can make, those returns correspondingly higher as well. So, all right. Well, cool. Well, changing gears here. Derek, how's it going, man?
Great. How you doing? Thanks for having me on. I appreciate it.
Totally. Yeah, a lot of fun. So do us a favor. Tell us about yourself, man.
Yeah. So I'm in the Phoenix market. I've grown up here my whole life. Was a military veteran as yourself in the Navy.
Yep.
After I got out of the Navy, I went into college with the government GI Bill.
Yep.
Graduated from Arizona State University with a bachelor degree in business and real estate. And that was in 2009, which was, a great time to get into real estate, not knowing anything. I was also in the process of getting married. And so I needed a job when I got out and just kind of fell into commercial brokerage. Did a little bit of everything in the commercial brokerage world. I did leasing for a while. Then I switched over to retail investment sales. Did that for the past 8 years. Till about a year ago, I just was like, now's the time to strike out on my own and go more on the investing side and take my knowledge to finding deals for myself. And multifamily was the asset class I've always had the most interest in. And now I've bought my first little deal on our own, and now I'm in the market to buy more. And
Awesome. How big was that first little deal you bought?
it was just a triplex. We did it with our own cash money, and
Yeah.
It's been a great little deal. We're
Awesome.
pulling like $2,000 a month on that one, so it's been a
Yeah.
deal.
Wow,
That's called an all day deal. One that I do that all day long. So
I need like 50 more of them.
Yeah, right. Yeah. And that's kind of the trade-off. Some of the smaller deals you can get a little better cash flow on, but then you have to get 50 of them or 100 of them. But,
exactly.
Yeah. Awesome. So one question, like I said, that I ask everybody about the why, why launching into real estate, what is your big burning why?
So I'd say my big burning why is just the time of freedom to go and do things with my family as we want. My wife's got her own career where she has very flexible freedom. I just wanted to have the same freedom to where, if we want to go on a vacation with our kids, we can, and just take time with our family and really dive in as a family unit more. So I was looking for more of the freedom of time.
Yeah. I think a lot of people are looking for exactly that, time freedom, being able to spend time with the people that you like. So awesome. Well, we got Paul on the line. So Derek, what do you want to ask him?
Thanks for your time, Paul. It's great to just be around you and Brian. Just like Brian mentioned, surround yourself with people. I 100% agree with that. It's just great to be around people of your guys' quality and status. So I wanted to just first thank you guys both. So
Thanks.
My first question I would say is, why did you start in multifamily versus other asset classes, retail, industrial, office? Why multifamily?
I didn't mention the details of this, but I actually started first, and this is a little embarrassing, and I don't know if I've ever shared this on a podcast either, but we actually set up a quasi-hotel, quasi-multifamily in North Dakota in the Bakken. So stepping back a little bit, I still had petroleum engineering on the brain all those years, just a little bit. I always thought I'd like to be an investor in oil and gas. And so when real estate tanked in 2008, I went from having some pretty decent net worth to $2.5 million in debt. And I actually went through a very fun, and I mean that literally, process to get debt free by 2009 without any bankruptcy or anything. It was just a wonderful experience, it turned out, and very providential, wonderful time. But at any rate, in 2010 or 11, I was thinking, I don't know, I might just have to get out of real estate. I don't know if it's going to work. And so I started looking at investing in oil and gas again. And we did in North Dakota in 2010. Well, by 2011, we realized there is a massive housing shortage up there. And my partner and I had been in real estate. So we quickly, and I mean quickly, this is the same guy I went to grad school in Ford with, we decided to build property up there. I guess you could call it multifamily quasi-hotels that we could use either as apartments or hotels for oil workers traveling up there. There's 19,000 job openings. And so we were thrust in to multifamily and quasi-hotel, whatever you call it. Some people called them man camps quickly. And the embarrassing part is 2.5 years later, when we went to sell the property, one of the buyers asked for a rent roll. And I said, what's a rent roll? And so that's how much I knew before my multifamily mentoring, my friends.
Yep. Oh, geez. And Derek, to answer the same question, I had bought several single family homes, and I was on a quest to figure out how to scale, and apartments ended up being the natural thing. But one thing that appealed to me about apartments versus retail or anything else is I felt that I understood apartments better because I've lived in them. I've paid rent in them. I've been on the other side of the equation. I've never rented a retail space. I've never rented industrial, or at least industrial space. So one of the biggest things for me was I felt like I understood it. I also didn't know what a rent roll was. I also didn't know a lot of that stuff, but I felt like the overall dynamics was something that I understood intrinsically for having done it before.
Yeah, that makes sense. Okay.
Can I change my answer to what Brian said?
We'll just go through it and all that other stuff out. And yeah.
Okay, good.
Yeah. All right. Yeah, I'm curious on what type of returns you guys are looking for in today's market.
That's a tough one.
With things changing so much, it's a moving target, I know, but I'm always interested to hear what other people are shooting for.
Yeah. With preferred equity, we are getting, and this is, you can see why we're doing it now. There's such a need for it, and it's so beneficial to everybody if the deal goes well, that we're able to get about a 9 or 10% current cash flow and about 6 to 7% upside compounded on top of that, plus some fees at closing. So we're looking at sometimes always 15 to 18% total annual return.
Yeah.
If they buy us out early, and there's a big advantage to them buying us out if they can, let's say 2 years in. If it's a 3-year deal and when they buy us out in 2, we have a MOIC, multiple on invested capital floor, which can mean we get even a better return in some cases.
Yeah. Interesting. Yeah. I've talked with a lot of pref equity, and, really what came through my mind between pref equity and common equity is the numbers are about the same.
Yeah.
But pref equity is a little bit, it's lower on the capital stack, like you said. So, the question for me when determining pref equity versus regular, common equity is, can I raise that amount? Because I think I end up making a lot more if I can raise that amount. But if I can't, the pref equity is a really easy, well, it's not easy, but you're right. It is very much in demand because a lot of people are having a hard time raising the common equity. So people like me who are trying to raise money from individual retail investors, if we're not able to raise our number, pref equity is where a lot of us are turning. So, and Derek, I'm going to say we're right about the same numbers. We want to be above 15% on our average annual returns. With where rates are right now, it's hard to hit those numbers, but we're trying to find ways where we can get creative. We're working on a couple of deals right now where we have some sort of creative finance structure where we have sellers carrying a second mortgage or putting equity back into the property. We've got 2 deals that we're negotiating right now that have different types of seller financing involved. So we're trying to get just a little more creative on stuff to see if we can, get those numbers. But yeah, that's what it's taking right now.
Okay. Yeah. What about cash on cash? Is there a number there you guys are targeting?
Well, with the pref equity, 9 to 10%.
Yeah.
On the cash flow from operations is what I would call it.
Yeah. And on the common equity, if year one, now the problem we're having with cash on cash is we're having to raise a larger amount, so instead of a 25% down payment, we're putting 40 and 50% down, which dilutes the cash flow. I mean, our debt service ratios are a lot higher, so we're looking at, some debt service ratios, especially on our creative financing deals. We're looking at debt service ratios 1.5 to 2 because we are, assuming debt and but what that means is it's diluted over, more investors. So we're still around, 5% right now on cash on those types of deals. So, I mean, I heard this from one investor, 2 weeks ago. I can just put my money in T-bills right now and get 4% cash on cash, and, so our cash on cash, 4 to 5% is about what we're getting. But I think with the lower levered deals, it's a safer 4%. Yeah. And it is a lot better than T-bills. I'll be honest.
Oh, absolutely.
Yeah.
I want to make something clear too. I'm not saying we're giving our investors that much, because we have a diversified fund and we have a bunch of deals that are, value add, and they have 0 payout for year one.
Yeah.
So our mix, when you put all that in the mix and give our investors our payouts, it's closer to what, it's really more what Brian said to the investor at this time.
Nice.
So for the current market and how volatile things are right now, how do you manage the risk in the multifamily investments that you guys are working on or have?
Yeah, the way we manage risk is extreme due diligence. We do as much due diligence on the operator as we can. Then secondly, the due diligence on the deal. And then third, changing our place in the capital stack by going down to pref equity.
Yeah. Yeah. And as I alluded to earlier, we're coming in with lower leverage. Right now, the way we're making most of our deals pencil is by assuming loans, and if the loan's been on the books for a couple of years, the LTV is a little bit lower. So if we're coming in, 50 and 65% on LTV, our debt service is higher. Our debt service ratio is higher, which means we've got a lot more movement. We got, we can have a really, really bad day and still be cash positive, right? So how we're mitigating it right now is we're looking for quality properties in good areas, and we're coming in with lower leverage, so we have that higher debt service. So yeah, our returns might not be as sexy as what a lot of people were talking about 2 and 3 years ago, but there's a higher likelihood that we're going to hit them.
Yeah, makes sense. Good. I'd say, what challenges have you encountered as a multifamily investor, and how did you overcome those?
The biggest challenge we had is when we were a multifamily syndicator, I mentioned, and that was a number of years ago before we started doing funds, we were not a good asset manager. I mean, I hope I don't step on too many people's toes here, but we were told by a very, very good mentor, somehow or another, we heard him say this, and I don't know that he said it this way, but raising the money is the hard part. Finding the deals is the other hard part. Managing the assets is easy. And it's just not true. I mean, I don't think it's true. I have a bunch of multifamily syndicators you guys would know the names of in a monthly, 90-minute call. Most months, the biggest pain I hear is I had to fire another property manager.
Yeah. The asset management is the difficult part, and different parts of the market cycle. I mean, if you looked at, what was happening with prices from, I don't know, like 2000, starting even 2016, maybe earlier, all the way till about a year and a half ago, you didn't have to manage well to make money. Right now, I think that's going to be completely opposite. So the management is difficult. And I think a lot of people look at it, like Paul just said, is a lot of people look at it like getting the deal is hard, and raising the money is hard. But, once that's done, it's just easy. And you can't just turn over the keys to the property management company and go. Something I began to wonder myself, and we fired a lot of property management companies. After firing, property management company number 4 with a previous partnership, I started asking the question, is it them or is it us? My inclination was to start pointing the finger at us, and saying we need to do something better, or we're just going to keep on firing property managers. But yeah, a lot of that asset management is dealing with the property managers and, helping them to perform properly. And I think a lot of times that's not, a lot of people push most of the responsibility and most of the blame towards the property management companies.
Yeah, Derek, we were told, and I even boldly asserted in my book, that you should always have a third-party property management company. And I was told that by my mentor in very clear terms. But of the 8 or 9 guys in that multifamily mastermind I'm in, most of them have concluded that that's not true.
Yeah. I had somebody, and he's one of the people that I call when I have issues, light years ahead of me. Remember 3 or 4 years ago, he told me very emphatically, I will never, ever bring management in-house. Never, ever, 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 ever. And I remember seeing him later, and we were sitting down to lunch. He's like, Brian, you're not going to believe me when I say this, but we just brought management in-house.
Yeah.
And it was the same thing. He had the same reasoning. He's like, you know what? I mean, the reason they didn't before was the liability, because if the property management screws up, they assume a lot of the liability. And, when you own both, if you're the property, if you own the management company and the asset, you're exposing yourself to a lot more liability. But that was his main reason up there. But end of the day, he started saying, yeah, we have to do it. We have to do it. So
yeah. That's great. That's great. I guess my next question is probably my last one that I can come up with right now, but for new investors, what would you guys suggest a new investor do to, successfully close their first deal and make it, one that lasts?
Closing first deal and making it last. A lot of it's just dedication. I think, being dedicated to an outcome. Now, maybe I'll answer your question indirectly. What I see a lot with first deals is people are getting into something small, right? I mean, most people want to operate at the 200 unit level and whatnot. They want to buy the big deals. And there's lots of good reasons for that. What I see happening a lot is you buy your first deal because it's something that you can attain, something you can reach right now. It might be a 40 unit instead of that 200 unit. But when people start getting traction and start getting to that level where they're doing these 200 unit deals, they look back at their first deal and they start thinking, man, we're putting a lot of time and effort into that deal and we're not making a lot of money. So what I see happen a lot with the syndicators that are growing, and especially growing fast, is that first deal ends up coming on a chopping block a lot quicker than people had planned. If it was supposed to be a 5-year, 8-year hold, maybe they're offloading it in 3. But
that's right.
So that's what I see a lot. I know it's not a direct answer to your question, but I'm coming at it from a different angle.
No, I like that. Thank you.
Yeah. I mean, I dedicated the last 1/3 of my new book to how to start into commercial real estate, including multifamily, self-storage, and other types. And so those 7 paths, if I can do it from memory, number 1 is be a deal finder. And I got literally a random call yesterday from a deal finder saying, hey, I'm really good at finding deals. Do you want me to work for you? Like as an independent contractor. Second is a money raiser, and that's fraught with difficulties with the SEC. Third would be to just jump in at a big level. Like if you've got a lot of money or you're an NFL, retiree or win the lotto, just jump in. Fourth this would be the first one in my book, and that would be stair step, a little bit what Brian said, start smaller, then you go bigger and bigger and bigger. Fifth would be to get a job, and that would be, and that sounds kind of crazy, but get a job at a property management company, or like you did very smartly, Derek, getting a job in commercial realty or commercial brokerage or commercial lending. I know a guy who took a 50% pay cut to go to be a self-storage property manager so he could learn the business inside out. The sixth unique path is being a passive investor and trying to get to know the syndicator really well so you can kind of track what they're doing. And then the seventh path, of course, is get a mentor or a paid coach.
Oh, great. Thank you.
I like those. Yeah. I like those. When people talk to me about how to get in, I usually put 3 paths in front of them, but there are more than 3. I like that. I like those numbers. Now, speaking of book, where can we get a copy of that book?
That book is called Storing Up Profits, How to Capitalize on America's Obsession with Stuff by Investing in Self-Storage. It's available at biggerpockets.com/storage.
Okay.
Or of course, it's available on Amazon as well.
Awesome. And there we go. It's got a moving box on the cover. So yeah, I like it. So if you're looking for it, it's got a red cover with a moving box on it, Storing Up Profits. So we'll put a link to that in the show notes as well. But anyway, we are about out of time. So one last question for each of you. And Paul, you get to go first. How can listeners learn more about you?
Yeah, the best way is follow me on Twitter at Paul Moore Invest. And if they want to learn anything about our company, they can go to wellingscapital.com /resources will get them access to a free copy of my PDF book on multifamily and special reports on all kinds of other asset classes.
Awesome. Awesome. And Derek, same question for you. How can listeners learn more about you?
For me, phone call, text. I love talking to people. So my phone number, I don't mind sharing. It's 480-213-2531. Call, text, love to chat and get to know everybody I can.
Awesome. And we'll put a link to that in the show notes. So anybody want to reach out to him, you'll have his phone number down there. And Paul, serious about that $1,000 donation. It's, just let me know, how to get it to you, and we'll do that. And then if you want to email me the information for how others can participate, we'll put that in the show notes as well.
Okay, great. Well, thank you so much. I really am so honored to be here. It's great to see you again, Brian, and what an honor to meet you as well, Derek. Thank you both for serving our country too.
Thanks. Appreciate it.
Thank you, Paul. Great meeting you too. And Brian, it's always a pleasure speaking with you.
Yeah. Thanks, guys. Appreciate your time today. Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.